Let's talk to David Paul. He is the MD of VectorVest UK. Very good morning to you, young David.
Morning, Mus.
Right, we've got a lot of slides to whiz through. Let's kick off. The headline, 4 mistakes preventing consistent market gains.
Well, yes, these are 4 mistakes that I've been involved with both retail and institutional portfolios, well, since I suppose now about 1990. And I've noted these 4 mistakes coming up over and over again at both retail and institutional level. And hopefully, knowing about them, we can get our minds around them a little bit. So the 4 mistakes, the first one, which is in the next slide, I think encompasses many of them. And I've entitled it, Thinking of the Money First. Now, you may say to yourself, well, the only reason we're going anywhere near a market is to make money, and that's certainly true for every profession. But most of you think of the best dentist in your area, with the biggest car and a practice full of, a waiting room full of customers. That gentleman has built his business up because he focuses on perfect execution of each procedure. And if he takes care and focuses on perfect execution of each root canal, his waiting room will be full and he can pretty much charge what he wants. And it's exactly the same in trading. Our objective as traders is to focus on perfect execution of this one trade. Not worrying about the past, not thinking about the future, but following our simple set of rules on this one trade. And if we focus on perfect execution, and if we focus on the process of trading, the cash will take care of itself. And when you allow your mind the luxury to move to the past, in the next slide, you can become incredibly emotional. And our minds have been hardwired to relive the past, and we've also been hardwired to avoid pain. So your mind relives the past, it wants to avoid the pain, and you find up making a multitude of errors, mostly hesitating and not taking the trade that you should take. So as far as I'm concerned, the key to the exercise, in exactly the same way as the key to playing good golf, is to focus on perfect execution of this one stroke. Not the last one, not the next one. And the difference between a really good golfer and yours truly is that he can lose a few strokes on the 4th, and on the 5th he plays that as if that's never happened. Okay, focuses on perfect execution of this one stroke. And the rest of the errors are in fact are a part of this one. But on the next slide, I think the next biggest error is buying stocks that are falling, and we've been sort of coached in this pound cost averaging, etc. And it may work in exchange traded funds, it may work in unit trusts, but my word, it can give you a hiding in stocks. In South Africa and Germany, for example, there's a company, biggest mattress producer in the whole world, called Steinhoff, and about this time last year, it was trading in South Africa at 120 rands a share. It fell to 1 rand 50 a share during the course of the last year. So if you'd bought that falling, I'm not saying for seconds you don't buy a pullback. A pullback in a strong trend, that can be a great entry point. And as I've told you, I think a couple of meetings ago, I like to look at 3 moving averages, 21, 55 and 89, and when the 21's above the 55, which is above the 89, I've got a share in a strong trend. I'm buying a little bit of a pullback in that, but is great. But if it cracks the 89-day moving average, then I start to get worried, and buying stocks that are falling has bankrupted, the old 2 for the price of 1 has bankrupted more traders than anything else out there.
Oh, yes. Okay, so let's move on to the next slide.
Well, the next one, of course, is a part of that as well, which is holding on to losers too long. Where you get emotionally married to the thing. And even worse, of course, is adding to those losers along the way. And in the UK, remember Marconi? Remember that icon of the FTSE? Fell from £13 to a few pennies. So holding on to losers too long, and it took me a long time to find that fella in the T-shirt. but holding on to losers too long. And then the last big mistake, of course, in the next slide is, well, no exit plan. That's a part of that. But the last big mistake in the next slide is, in fact, not focusing or not being aware of market direction. Whether the market is rising or falling, everything follows from that. And it's like a roller coaster that I've put in the next slide. I think it takes one heck of a long time to get up there, but falls very fast indeed.
Yeah.
We've been coached again that buy and hold is the only way to go. I remember when I started in markets, it was my mentor at the time told me that when markets made a peak in 1970, it took them 21 years to actually get back up to that level again in real money. So buy and hold is just great if you've got many, many years to wait. Nevertheless, at VectorVest, our motto is that we want to buy shares with great fundamentals that are rising, that are in the throes of a strong trend, and we want to buy them when the general market is rising. So we're very, very aware of market timing, and we have market timing tools for traders who want to be swing traders, want to be spread bettors, and we've got market timing tools for long-term position traders. And that just shows the American market, the pullback to 2003, then what's now called the global financial crisis, and we've now got a market which is still rising, and it's still, in our view, a bull market fundamentally.
Right.
And although there was a furore in the paper last weekend that the Dow had pulled back, it had only pulled back to the low of about 10 days ago, so it's hardly a bear market as yet. NASDAQ had a much more serious crack. But our fundamental model, based on the work of Dr. Bart DeLida, who's the founder of VectorVest, based on earnings, interest rates and inflation, still tells us that we're in a US bull market. Okay.
Understood. Okay, so let's move on to the next slide.
Well, I'm going to ask you, Miss, which one of those four mistakes has cost you most money over the years? So
I think a combination of everything, to be honest. You clearly remember your losers very, very well in terms of, you know, the heavy losses. So I won't comment too much.
Holding on to losers.
And averaging the wrong way.
Yeah,
et cetera,
I started in markets in 1982, and between 1982 and 1984, I put together quite a large sum of money.
And you lost it all
for that time. For that time of my life,
yeah.
Quite a large sum of money. And when I started, I knew nothing. I was a mechanical engineer. I knew nothing about markets. 2 or 3 years into the process, I was now a guru. I thought that I knew something. And I became attached to one particular share, and I just watched it fall and fall and fall. And by 1984, I'd pretty much given away all I'd made in the previous 2 years. And I was living in Johannesburg at the time. I remember going out to a mountain outside Johannesburg and sitting and meditating for a full weekend to make sure that that would never happen again.
Right.
So I managed to cure myself of that via a very painful experience. But as far as I'm concerned, I've examined an awful lot of investors' accounts and traders' accounts, and the following, as far as I'm concerned, is the holy grail. The spread betting companies themselves say that only about 10 or 15% of people make any money with them, and they've got that in their adverts these days. And I've looked at the winners and I've looked at the losers. And it's quite simple. The winners, in fact, think quite differently from the losers. Now, when a losing trader has got a winning trade, when they've got a winning trade, they very quickly become pessimistic. They become pessimistic that the market is going to snap their money away.
Yeah.
And when a losing trader has got a losing position, they become optimistic. They become optimistic that the darn thing's going to turn around. Now, winning traders simply think differently. When a winning trader has got a winning position, they become optimistic. And when they've got a losing position, they become pessimistic very quickly. So my challenge to everybody listening is that on your next trade or your next investment, become aware of your thinking. If the thing goes your way, do your best to become optimistic and let the darn thing run. if the thing doesn't go your way, become pessimistic very, very quickly indeed. Now, if you're honest and you examine your thinking, about 90% of the people out there that try to be traders and try to be consistent get that the wrong way around. And I've changed more traders around by making them mentally aware of that little switch than anything else. So if you want to be successful and you've got a winning position, when you have a winning trade, become optimistic, and when you have a losing trade, become pessimistic very quickly. 90% of people get that wrong.
Okay, we've got 2 slides to go.
Well, our general market is heading down again. And,
Right.
it's been, as you can see, we had good times. And since June 2017, the road has been rocky. We had quite a nice move up from April this year, the 17th of April. But the longer-term trend and the shorter-term trend on the London market down. And it's a time to be watching stop losses very carefully and not to be entering any new positions in our view.
Understood. And the final slide.
Well, that's david.paul@vectorvest.com. We're going to be at the Investor Show next Friday at Novotel in Hammersmith. Anybody will have a stand there, and I'll be speaking. I'm speaking twice during the course of the day, and anybody who wants to come along, it'll be great to see them. And I'll be talking again about that, what I call the Holy Grail of trading, which is that little mental switch that we spoke about a moment ago.
Well, I think the only thing I would add to that is make sure you do your homework and be prepared. David, thank you very much indeed.